Good morning, good afternoon, good evening. Soon you're going to have your first assessment. And I wanted to give you a quick training before you go to the first assessment. So in the following pages, there will be a short repetition of some of the things that we've been through during classes, and also some of the helping materials that you have. Please enjoy. Your first exam will be based on the first lectures that we've had. They have been concentrated on Chapter 1, Chapter 2, Chapter 3, Chapter 6, and 7. Chapter 1 is Introduction. Chapter 2 is on the balance sheet. Chapter 3 is on the profit and loss statement. And Chapters 6 and 7 are the ratios. Please do remember that it is your responsibility to read through the chapters, study the slide sheet decks, make sure that whatever you use in the Excel sheet, that the formulas that you use are right for the purpose, etc. Throughout the course, we've been using the Excel sheet in various versions. The last versions includes all the ratios from chapter 6 and 7. You have slides from me, you have slides from De Montfort University. You have 3 different tests. They are here as links, so if you haven't had the time to do them before, you can do them now. Simply click on them and do the test. Remember that the Excel sheet shows both KPIs, the type of KPI, which chapter that you can read more about the KPI in, the formula, and an accounting example on the year 2019 on the accounting example that is included in the first chapters in the book. I hope this will provide you with help. Make sure that you understand the formulas that you are using, that you use them in the right way. Let's have a look at the first chapter in the book. This chapter defines accounting as past events that are being summarized into numerical information. So the accounting takes the different actions and converts them into numerical information. And the management in the company use that to hopefully make better decisions and also to control the company. The idea is for accounting to help managers decide a lot of different decisions. Just to give you some examples here, how much to produce? Should we hire more employees? How should we finance our expansion? The accounting should be relevant and faithful. And information in the accounting should be comparable, verifiable, timely, and understandable. I hope you remember the accounting example in the Excel sheet that we've been using throughout classes. Because in chapter 2, the balance sheet is shown. The balance sheet is about assets, and to have an asset, we need to have a present economic resource that is controlled by the entity as a result of a past event, i.e., they bought it. They now own it. And it is a car, so it's a present economic resource. It has a future economic benefit. The car can be sold in the future, or we can use the car in our company. And the asset should be something that we can measure faithfully. Again, the same definition as we had before. Total assets are obviously equal to the total liabilities and equity. And assets can either be measured in historic cost, which is what we normally do. But companies that have, i.e., premises, buildings, they can often choose to value those in fair value. The reason for that is that there is a market that gives a fair value for these assets. The book also notes that the idea with the accounting is not to show the value of the company, but to help managers, investors, and others to assess opportunities, options in the company that determines value. And for those of you that think that employees are the most important assets in companies, then remember that employees and many other of the concepts that we talk about being very important for the company are not assets. In the balance sheet, we have first the assets and we have the non-current assets. These are the assets that the company is deciding to keep. Machinery, property, plant, equipment, and also intangible assets such as goodwill that they have bought earlier, trademarks, etc. They have the current assets for which the idea is that the company will probably try to sell them or convert them into other assets, such as inventories. The reason for the company to hold inventories is to sell them. The reason for the company to give credit to its customers and thus create trade receivables is that they hope that this money will be paid back to the company. On the liability side, we have equity that consists of the share capital in nominal terms plus the top-off that has been paid by the investors. So the nominal share capital could be 1 crown for each share, but investors paid 8 crown. So there are 7 crowns on top of the nominal value of the share capital. We will then add the retained earnings, meaning the profit that the company is generating throughout periods. And if the company is paying out dividend, we also need to note that here. Non-current and current on the liability side has the same meaning as on the assets. Non-current are longer term liabilities, meaning they should not be paid back in the next year, but after more than 1 year. Whereas current liabilities are to be paid back before the end of 1 year. In chapter 3, we are introduced to the profit and loss statement. It begins with revenues and cost of sales are deducted. Cost of sales are all the costs incurred directly in the making or buying of the products. Could be raw materials, electricity, etc. We have gross profit, which is just one example of a key ratio that we use to analyze the different parts of the accounting. Here in the profit and loss statement, we have gross profit percentage, operating profit percentage, profit before tax percentage, and profit after tax percentage. which is also called profit for the year percentage. We have depreciations in the P&L, which is to show the consumption of the assets that we have in the period of the profit and loss statement. We have two methods for depreciating assets, either straight line, meaning the same amount every year, or reducing balance method, meaning using the same proportional depreciation each year, i.e. 25% a year. The accounting also shows the area of accruals. Only the month that the profit and loss statement is depicting should be included in the profit and loss statement. So if the profit and loss statement is for 2019 and we have paid in advance 15 months of rent, then 3 of these months are related to 2020 and should not be a cost in 2019. Let's see an example of a straight line depreciation. The company has bought a car. It has been bought at the value 250,000. The company wishes to depreciate the car over 8 years, as they expect to be able to use the car in the distribution function for the next 8 years. That what they're looking for here is a straight line depreciation. Each year should then be depreciated with 12.5%. That means the depreciation each year will be 31.25. So here in the first year, we're reducing the book value of 250,000 with 31.25. And that should be 228.75, which is then the book value at the end of the year. The company could also use the reducing balance depreciation method. Still the same car, still bought at 250,000. It should be depreciated with 25% every year. That has been decided by the company. Depreciation will thus be 62.5%. 62,500 in the first year, leaving an asset value of 187,500. Then next year, the 25% will be taken off the 187,500. I hope you remember this slide. We've been using a couple of times during our classes. It tells us different reasons for using ratios. Also remind us that ratios are not the end in itself, and that they should motivate management and others to ask more questions and do more analysis. Okay, now we're at the last page of this short introduction and repetition. This is related to the chapters 6 and 7. And these chapters are included in the Excel sheet, where you can find profitability ratios, such as gross profit percentage, operating profit percentage, profit after tax percentage. You can find efficiency ratios, such as sales per employee, sales per sales point. You can find performance ratios, such as earnings per share. You can find capital structure ratios. An example of that is gearing ratio. Then return on capital employed was one of the really important KPIs. Capital employed is equity and long-term borrowings. Liquidity ratios such as current ratios. And working capital such as inventory days, payable days, receivable days, and cash conversion cycle. that is inventory days plus receivable days minus payable days. Now let's take an example. If the cash conversion cycle gives you a negative figure, it means that the company is good at converting sales into cash flow. We talked about that a number of times, that companies do not necessarily have a problem because they do not make a profit. But a company that is lack of capital will have a problem. So these different ratios are really important, and you can use the Excel sheet to study them further. I'm therefore showing a part of the Excel sheet again. It's to motivate you to use it as a very simple and easy way of training, as well as you should read the books, study the slide sheets, and use the test that I gave you. Now I wish you the best of luck. I look forward to seeing you a couple of weeks ahead when we will have lessons again and when you will be done with your assessment. Good luck.